can you just going back to the basics, can you explain like FHA, VA, and conventional type of loans and how you calculate the ratios?
So there are really kind of 5 different real loans types today. You've got the standard conventional, which is Fannie and Freddie. You've got FHA, Federal Housing Administration, VA, which is Veterans Administration, USDA, not as common in our area, but that's the Agricultural Administration. And all those run the different ratios, different mortgage insurance or not having mortgage insurance differently. So the conventional loan, generally speaking, you can do as little as 3% down. If you get to 20% down, and this is where the big difference comes in, is there's no mortgage insurance. So depending on your scenario, on these low down payments, we would look at those differently. Conventional generally has about a 45% debt to income ratio limit. Now, all these loan programs go through what we call an ASU, automated underwriting system. It's basically today's word, an AI that tells you whether you can get your loan approved or not. But FHA has a much higher debt to income ratio. VA can actually go up to 65% debt to income ratio, but it does have another calculation in the background that tells you whether you can actually afford that or not. Conventional, again, is 45, and USDA is around 50. It tends to trend with FHA. Again, the biggest differences, though, is that mortgage insurance premium. If you don't have really good credit and you're doing lower than 20% down, most times it's actually less expensive and easier to go under FHA. It's a more flexible program. It has flexibility on its debt-to-income ratios, it has flexibility on its credit guidelines, much more than a conventional Fannie Freddie loan. If you're talking about VA, it is the best first-time homebuyer program, but you have to be a vet, or you have to be married to a vet, or a deceased spouse of a vet, so everybody can't tap into that. But it is the greatest program. There's no mortgage insurance, even though it has a funding fee if you're not disabled, and it can go up to a high debt-to-income ratio. And USDA has to be a rural home area. You can look on the map, USDA.gov. You can find the maps out there. Talk to me, talk to Mueller about it. We can find it out there. There are areas in Maryland and Virginia, and not in DC, but in the outskirts, like north of Damascus, where we're at. We're in Sandy Spring today. And north of Damascus, there are lots of places where you can use the USDA, which is 100% financing. It used to be a no mortgage insurance program, but now it's just a low mortgage insurance program. So depending on those simple things that go on, again, the loan to values and your credit score depend on which program will work best for you, but there are lots of options between those ones.